Gold and silver aren't rallying. They're repricing the cost of trust, and the spread is the part nobody can Photoshop. The headlines will try to frame this like a mood swing, like investors woke up nervous, clicked buy, and now we're all supposed to clap because the chart is pointing up. But that story is too clean, too comfortable. Because what is actually happening right now is a tug of war between the visible price you see on the screen and the invisible mechanics underneath it that decide whether that price can hold. And if you own gold or silver, the difference between those two worlds is the difference between getting shaken out by noise and understanding what the market is forcing participants to do next. Stay with me, because later in this video I'm going to give you a simple, near-term roadmap. What levels matter, what confirms the move, what breaks the thesis, and what the next 1 to 2 week calendar is quietly setting up. And there was one hidden detail most people missed that changes the entire why now story. Here's the conflict nobody wants to say out loud. When a market starts to move in a way that threatens established positioning, the first response from the system is not to admit a new regime. The first response is to raise friction. Volatility spikes, margins rise, liquidity thins, spreads widen, the tape gets jumpy. And suddenly, the same crowd that chased the move is forced to sell into it, not because they changed their mind, but because the plumbing told them to. That's not conspiracy. That's incentives and risk management. It's how leveraged participants survive. It's how clearinghouses keep the lights on. And it's also how big moves get delayed, disguised, and ironically strengthened, because the weak hands get removed before the next leg starts. But that's not the part that matters. The part that matters is where the real signal lives, and it's not in the headline candle. If you want the truth in precious metals, stop staring at the last traded print and start watching what it costs to push metal through time. That's where the real pressure starts. Because gold and silver are not just things people buy. They're markets with term structure, futures, options, delivery windows, financing, storage, arbitrage. And when the surface price says one thing but the structure beneath it says another, that mismatch is the warning light. It's the market whispering, this is not normal. And when enough warning lights come on at the same time, that's when something big really is starting. So let's ground this in what you can actually feel right now. Gold has been holding in a high range, hovering around the low to mid 4,000s per ounce after a year that shattered old assumptions. Silver has been fighting in the low 70s, where every dollar move feels like a punch because the market is smaller, thinner, and far more reactive. And that's already telling you something. When silver moves, it tends to move like a door in a storm. The same wind pressure that barely nudges gold can slam silver open. The question is not up or down tomorrow. The question is what kind of move this is, emotional or mechanical. And that brings us to the hidden detail most people missed. The next move isn't just about fear, inflation, or a dramatic headline. It has about a calendar window that forces automatic selling and automatic hedging at the exact wrong time. This week isn't just another week. There's a known mechanical flow event tied to commodity index rebalancing that kicks in during a tight window in early January. Index funds that track broad commodity benchmarks on T decide to buy or sell like a human does. They rebalance because they have to. They sell what got too big. They buy what got too small. They execute on a schedule. And when gold and silver have already been running hot, that rebalance can translate into forced selling in futures, real, measurable flow, regardless of anyone's opinion about the long-term story. Now here's the trap. Most people see that selling and assume it's bearish. But if price and structure absorb it, if they stay firm while that wave hits, that's not weakness, that's strength. Because it means there's a bid underneath the market that is not flinching. And that changes the odds of what happens next. Because if this one level breaks, the math changes. Now stack a second tripwire on top of that calendar. Late January options expiry. Options are where the invisible hand of hedging becomes visible through price action. Because dealers aren't predicting, they're reacting. When a lot of call options sit near the money, dealers who sold those calls hedge by buying futures as price rises and selling futures as price falls. That's delta hedging. In calm conditions, it dampens moves. But in certain setups, especially when gamma is concentrated near key strikes, it can amplify moves. Up moves force more buying, down moves force more selling. Not because anyone is panicking, but because hedging math is doing what it's designed to do. And when options expiry approaches, the structure changes. The hedges roll. The pinning forces weaken. The reflexivity can snap. And that's why the calendar matters. Not because it's magical, but because it's mechanical. The next detail is what flips the whole setup. If the market is strong enough to absorb forced selling now, the same structure that suppressed it can fuel the next leg later. But before we talk targets or timelines, we have to talk about the most misunderstood fight in metals. Paper versus physical. Not in a cartoonish, everything is fake way. In a practical way. Because in these markets, not all inventory is real inventory. Some metal is in the building, and some metal is actually for sale. Some is deliverable, some is spoken for. Some sits in vaults as eligible inventory that can be converted into deliverable supply if the owner chooses, and some is registered for delivery against futures contracts. That distinction matters because futures are promises tied to delivery rules. When deliverable supply feels tight relative to claims, price discovery starts leaning on derivatives more than on bars moving through hands. And that's when the market can appear calm right before it isn't. Because when a large participant decides they want metal, not a cash settlement, the market has to find it. And finding it can mean paying up, changing spreads, pulling supply from somewhere else, or forcing shorts to cover into thin liquidity. And that's where the real pressure starts. Now here's your first proof layer. The demand behavior in gold has been changing. When people stop buying gold as jewelry and start buying it as bars, coins, and institutional products, that's not fashion. That's a regime signal. It means the buyer is less price sensitive. It means the motive is protection, not decoration. It means people are treating gold like insurance. And insurance demand doesn't politely step aside because a chart looks overbought. It persists until the fear it's hedging goes away. But that's not the whole story. The real story is who's buying beneath the surface, because the quietest buyer is usually the strongest buyer. Central banks have been a consistent bid in the modern gold market. And that matters for two reasons. First, central banks are not chasing Instagram narratives. They're managing reserves, currency exposure, and geopolitical risk. Second, they buy in a way that doesn't care about your daily candle. They're not flipping next week. That steady accumulation creates an undercurrent that changes how pullbacks behave. It doesn't make price immune to volatility, nothing does, but it changes the shape of risk, because it means dips can be met by players who don't panic sell on a red day. And that's why I'll see the market whip violently even if the thesis is correct. Volatility is not a verdict, it's a weapon. And if you don't understand that, the market will use it against you. Now layer on ETF flows, because this is where retail sentiment quietly turns into institutional reality. ETFs can look like paper, but they are a bridge. When investors pile into metal-backed ETFs, authorized participants create shares by sourcing metal, delivering it into the trust, and receiving shares they can distribute. That process links demand for a financial wrapper to demand for physical inventory. It also interacts with collateral behavior, because in stressed regimes, institutions value high-quality liquid assets differently. Gold can become not just a hedge, but a balance sheet tool. And when flows accelerate, it's not just buyers are bullish, it's the system is converting cash into vaulted metal and hedging around it. That has ripple effects. It changes available float, it changes leasing, it changes financing, and it changes how easily the market can satisfy sudden demand. But that's still not the part most people are watching. Most people are watching domestic headlines. Now, the cleaner tell is global. Watch China. One of the simplest signals in gold is what happens when China's import channel widens. When Chinese demand increases, whether from households, institutions, or the official sector, global flows shift, metal moves, premiums change. The arbitrage pulls. An arbitrage is not a theory. It's a magnet. If gold trades at a meaningful premium in one region versus another after adjusting for transport, financing, and taxes, metal moves from low premium to high premium markets until that spread closes. That movement can drain inventory from one hub and tighten another. It can also force futures curves and forwards to reflect the true scarcity cost. And that's the point. Price is not just a mood, it's a clearing mechanism for logistics. Now let's pivot to silver, because silver is where the something big can become obvious, fast. Silver is not just monetary metal. It is an industrial input. It goes into electronics, solar, electrification, and a modern economy that keeps finding new ways to consume conductivity. And industrial demand behaves differently than speculative demand. Industry often buys because it must. It has procurement cycles, it has production schedules. It doesn't stop making products because silver is pricey for a month. It tries to hedge. It tries to pass through costs. It looks for substitution, and sometimes there isn't much, which means that when silver supply is constrained, price doesn't just rise because people are excited. It rises because the real economy is bidding for it. And when the market is already tight, small shocks hit like a hammer. That's why silver's door can swing so violently, and that's where the real pressure starts. Now add the supply gate that almost nobody's pricing correctly, export controls. When a major producer tightens export rules on refined metal, you're not just talking about a headline. You're talking about a bottleneck. Mine supply is one thing. Refining and logistics are another. A market can have plenty of metal in the world and still face scarcity in deliverable form at the right time, in the right place, with the right specifications. If export controls restrict flow beginning January 1st, that changes the timing and availability of supply in a way that can show up as premiums, tightness in certain forms, and stress in spreads before the average investor notices. And that matters right now because timing is everything. A slow leak in supply doesn't always raise the spot price immediately. It raises the stress inside the system first. The price is the last thing to confess. So let's talk about that system stress in plain language. Contango versus backwardation. In a normal market, futures trade above spot because of cost of carry, storage, insurance, financing. That's contango. It's the market saying, to own it later, pay me for time. Backwardation is the opposite. Near-term prices are higher than later prices, signaling urgent demand for immediate supply. It doesn't need to be a dramatic inversion to matter. Sometimes the signal is in how the curve flattens, how nearby spreads tighten, how the cost to roll a position changes, how lease rates behave, how delivery incentives shift. This is why the price is lying and the spread is telling the truth is not just a punchy line. It's a framework, because spreads reveal whether the market is paying a premium for immediacy. And when the market pays for immediacy, it's telling you scarcity is not theoretical, it's operational. Now here's the brutal test that's coming: forced selling. Not because investors suddenly hate gold and silver, but because index rebalancing and risk controls can create a wave of mechanical selling. And when that wave hits, two outcomes matter. Scenario 1, controlled pullback and retest. Price dips, shakes out late leverage, then stabilizes above key support zones while spreads stay firm and buyers step in. That is a healthy market. It's the market exhaling. Scenario 2, continuation squeeze and gap risk. Price refuses to dip, liquidity thins, shorts scramble, dealers chase hedges, and you get vertical moves that look irrational until you realize they're forced. Both scenarios can happen within the same thesis. The difference is timing and pain. And the market loves to choose the path that hurts the most people. That's not evil. That's positioning. Let's talk positioning, because this is where retail investors get emotionally ambushed. A lot of people think short interest is a scoreboard. It's not. It's a balance. Shorts exist for reasons: hedging, market making, producers locking prices, funds expressing macro views. But shorts become vulnerable when price moves against them and volatility rises. Because higher volatility increases margin requirements. Higher margins mean more collateral is needed. If collateral isn't available, positions get reduced. That's forced covering. Not because someone admitted defeat, but because the risk manager demanded it. And forced covering in a thin market can cascade. The first cover pushes price up. That triggers more margin stress. That forces more covering. Liquidity thins as market makers widen spreads. And suddenly the move feeds itself. That's reflexivity. That's how small news becomes big price. And that's where the real pressure starts. Now, why does this matter more for silver? Because silver is the smaller door. Gold is a massive, deep market with central bank participation, large institutional flows, and broad global liquidity. Silver is smaller, more volatile, and more sensitive to incremental demand. That means a comparable flow shock can move silver more than gold. It also means volatility can be weaponized more easily. A 5% whip in gold might feel like noise. A similar move in silver can feel like the floor dropping out. And that's exactly how people get manipulated. Not by a villain, but by the market's nature. Volatility triggers the nervous system. It makes you interpret noise as signal. It makes you sell at the wrong time and buy back at a worse price. And if you don't build a psychology shield, the market will harvest your decisions. So here's the psychology shield in practical terms. Separate the trend signal from the noise. The trend signal is what happens at levels after the market has had time to react. The noise is what happens in the middle of a liquidation wick when liquidity is thin and someone is forced to do something. A big red candle does not automatically mean the thesis is dead. A big green candle does not automatically mean you're safe. What matters is structure. Does the market hold key zones on a retest? Or does it fail and accelerate lower? Does the curve stay tight or does it relax? Do physical premiums cool or do they persist? Do big buyers keep absorbing supply or do they step back? That's what you watch. That's how you avoid being emotionally yanked around by the tape. Now let's address the counterpoint, because skeptics deserve more than hype. Bubble talk is everywhere. It's too high. It's too fast. It's overextended. And look, discomfort is valid. Metals can overshoot. They can mean revert. They can trap late chasers. They can do all of that while still being in a structural uptrend. The mistake is thinking overbought is the same thing as wrong. Overbought is a condition. Wrong is a conclusion. And the difference between the two is what breaks the system stress. This setup only truly breaks if the pressure releases in specific places, if carry normalizes, if near-term tightness relaxes, if physical availability improves, if premiums cool in a sustained way, if the dollar and real yields shift in a way that removes the macro bid, and if the market can digest mechanical selling without finding aggressive buyers. In other words, the thesis isn't gold and silver go up forever. Now, the thesis is the market is behaving like it's repricing trust and scarcity. And the structure will tell you whether that's continuing or fading. Because if this one level breaks, the math changes. So what do you do with that this week? You build a checklist. Not a prediction, a checklist. Because prediction is ego. Checklist is process. Here are the kinds of things you watch without needing perfect numbers. First, reaction to forced flows. During the rebalance window, does selling produce a deep break or a shallow dip that gets bought? Second, liquidity behavior. Do spreads widen aggressively on down moves and then tighten on stabilization, or does liquidity remain thin and chaotic? Third, term structure cues. Does the curve flatten and stay tight, signaling urgency, or does it steepen and relax, signaling supply comfort? Fourth, physical symptoms. Are premiums and availability in common retail channels tightening or easing? Fifth, cross-market confirmation. Are mining equities confirming the move, lagging it, or diverging? Are related commodities and currency stress indicators aligning or fighting it? You're not looking for perfection. You're looking for alignment. Mechanism, behavior, symptom, structure, proof stacking. That's how you keep trust high. Your own trust in your process, not blind trust in a headline. And now the what comes next roadmap, because you deserve something concrete. Near term, you have that two scenario lens. In a controlled pullback scenario, price retraces into a prior breakout zone. Volatility spikes, sentiment flips bearish fast, and then the market finds footing. The tell is not the dip, the tell is the response. Does it reclaim levels quickly? Does selling exhaust? Do spreads stabilize? Does volume spike on the flush and then calm? That's often what a healthy retest looks like. In the squeeze scenario, price refuses to give you the polite entry. It grinds higher, then leaps, then gaps, because the market is forcing hedges and covering. The tell, there is acceleration with thinning liquidity, moves that happen quickly and feel unfair, and those moves can reverse sharply too. That's the warning. Even if the thesis is right, price can whip violently. This is not a straight line. This is a tug of war in a narrow hallway, and the hallway gets narrower when options expiry approaches, when forced rebalancing hits, and when supply gates tighten. That's where the real pressure starts. So let's translate all of this into simple levels and reactions, without pretending we know the exact tick that matters. For gold, watch whether prior support zones hold on pullbacks and whether new highs can hold after breakouts instead of instantly rejecting. For silver, watch the battle zones where it previously stalled. Those areas often become magnets. The key is not a single number. It's whether the market can break a level, accept it, and then defend it on a retest. Break, accept, defend, that's structure. If you see repeated failures, or breakouts that instantly collapse, rebounds that die quickly, spreads that relax, physical tightness that fades, that's the market telling you the stress is easing. That's how the thesis weakens. But if you see the opposite, dips getting absorbed, rallies holding, tightness persisting, and volatility being sold rather than feared, that's the market telling you the repricing is still on. Now here, a critical line that separates people who survive this from people who get churned. The market does not reward certainty, it rewards preparation. The loudest voices will try to sell you certainty. They'll tell you guaranteed, inevitable, see, unstoppable. Ignore that. This isn't about guarantees. This is about mechanisms and odds. It's about understanding what participants are forced to do. Index funds rebalance because they have to. Dealers hedge because they have to. Shorts cover when margin calls demand it. Industrial buyers procure because production demands it. Central banks allocate because reserve policy demands it. None of those forces care about your feelings, but they do leave footprints. And if you learn to read the footprints, you stop being surprised by volatility. You still feel it, but you don't obey it. One more layer before we close, because this is where trust gets built. Why this feels big is because multiple systems are pulling in the same direction at the same time. Macro uncertainty and reserve behavior create a baseline bid for gold. Investment demand channels translate sentiment into vaulted metal. Global flows and arbitrage shift supply to where it's valued most. Silver faces industrial pull and supply constraints that can be tightened by policy gates. Derivatives, structure and calendar events concentrate pressure into specific windows. And risk controls, margins, liquidity, position limits, can force liquidation that cleanses the move and sets up the next leg. That's a lot of layers. And when you see layers align, you pay attention. Not because you're chasing excitement, but because alignment is rare, and rare alignment is where big moves come from. Now, a quiet warning, because this is the part that protects you. Volatility will be used against you. It will come as fake breakdowns. It will come as sudden intraday reversals. It will come as headlines designed to make you feel stupid for holding and stupid for buying. It will come as social proof, the crowd laughing right before price turns. And that's why your checklist matters. If the structure remains intact, the noise is just noise. If the structure breaks, you adjust. You don't marry a narrative, you marry a process. That's how you keep your capital and your sanity. So here's your closing checklist for the next 1 to 2 weeks. In plain words, watch how gold and silver behave during the mechanical flow window. Do they hold up under known selling pressure, or do they crack? Watch how spreads and curve tightness behave. Do they keep signaling urgency, or do they relax? Watch for signs that physical constraints are easing or tightening. Availability, premiums, procurement chatter. Watch the approach into options expiry. Does price get pinned, then break, or does it drift and then snap? Watch liquidity. Does it thin in a way that makes moves discontinuous? And keep that 2-scenario lens in your head. Controlled retest versus squeeze continuation. The market can do either. Your job is not to predict with perfect accuracy. Your job is to recognize which one is unfolding early enough that you're not reacting like everyone else. And if you're still here, you're already doing something most people refuse to do. You're not chasing candles. You're building a framework. You're treating markets like systems instead of stories. That's the edge. That's the identity. That's the difference between being entertained by finance content and being equipped by it. If you want, stay close to this channel, not because I'm begging, because we're building a community that watches the mechanics, not the noise, and that's exactly what this moment demands. Next week, the market will try to convince you this was just a spike, or just a fad, or just a headline. Or don't fall for simple stories and complex systems. Watch the spreads, watch the calendar, watch who is forced to act. Because when gold and silver start repricing trust, they don't ask for permission. And the tape always looks quiet right before it doesn't.